Welcome, everyone. I'd like to welcome everyone to our 6th annual town hall meeting. This is the 6th year where we've been doing this, and every year what we do is we donate to the local food bank here in Fairlawn. Part of our profits do go to helping the local communities and the different food banks. But I wanted to get into some of the purpose of the town hall meeting. Some people have been at the town hall meeting, some people have not. It is a way of connecting with our clients. The 3 objectives are to provide an opportunity for, number 1, engagement. Encourage our clients to remain engaged and continue dialogue. The more our clients know what we're doing and why, the more comfortable they are. We find that this is what gives them peace of mind. As you probably have heard us mention, it's your money. You should know what we're doing with it and why, and for us to give you the logic behind it. Another important part is the educational piece. We believe that part of our job is to educate and inform. We do that through venues such as this town hall meeting. We've now been doing quarterly conference calls, which has seemed to be very successful. We've been getting a lot more people on the calls. And also we do webinars. So look for them through our email blasts, and if people don't have email, we're mailing out the hard mail, okay? The other part, which we all like, is the social and fun part. We have gone out of our way to work with people who we like. Some of our events are even more social, but we have found over the past years that people are looking for more information. Still, we want to enjoy the social time with our clients and the opportunity for the festivities afterwards with the fun desserts. My favorite, of course, is the fruit tart. It also provides you an opportunity to get to know us better, get to know the partners, get to know the rest of our team. But before we start, I would like to proudly introduce our team. The principals of the firm are Laura Mattia, James Shagawat, Anthony Bonante, and myself, Victor Canello. The client service people of the team, where the rubber meets the road, is Lucy DeRobertis in the back. Lucy, raise your hand. Peggy Braun, Peggy's back there. Fran Wiseman, Fran, and Nick Scheibner, a financial planner with us. Nick recently has passed the Certified Financial Planning Program, probably one of the, on the younger percentile of individuals who have passed the exam in the country. As you know, our philosophy is deeply rooted in true diversification. Our strategy remains steadfast. Number 1, remove all emotion from investing. Very important. We study behavioral finance, and most investors, without the proper guidance, will do the wrong thing at the wrong time, meaning they will buy when they should be selling, and they will sell when they should be buying. Our job is to prevent a client from making a big money mistake. And one of the ways of doing that is we meet as an investment committee to keep ourselves in checks and balances. Choose top quality investments based on merit. The way we do that is we use filters. So we have no allegiance to any investment that we use. Our allegiance is only to you, the client. So it's based on merit, so we use filters, and we filter out based on performance, obviously, bear market ranking, manager tenure, and of course the modern portfolio statistical data such as standard deviation, a measure of risk, alpha, beta, and all those other good things. Another big advantage of working with a firm like ours, and for the people who have worked with us for a while know it, is be able to buy at discounts. And what that means is we're able to get institutional pricing. Just take that word out and put the word wholesale. So we're able to purchase at wholesale pricing for, if you were a retail client of Charles Schwab, Fidelity, Merrill Lynch, and you were trying to purchase the exact same mutual funds that we're looking to purchase, you might pay a quarter or a 0.5% more. We love the institutional pricing for our clients because we're able to save on the expense ratio without putting out any more risk, okay? Another example would be in the bonds. We're able to buy bonds anywhere from any bond house. So if you are a retail customer and we're on the phone with the same bond house and we're looking to purchase a $100,000 General Electric bond with a term of 2 years, we're most likely going to be able to pay about $1,500 less for that bond because the retail consumer or the retail investor is going to pay up and have more embedded costs. So that does add to return. Rebalance when needed, very important. It's a beautiful strategy. It's a disciplined strategy. We don't rebalance on a calendar quarter. We don't wait for a certain date. We don't wait for where we do it once a year. We rebalance on a contingent basis, meaning when a certain asset class starts to get ahead of itself, we're going to sell a portion of that asset class and buy something that's underweighted. And by doing that, studies have shown it will add anywhere from 1% to 2% to long-term return while reducing risk. So we love to do that, and we love to add value. And of course, always with our clients' best interests in mind. As you know, we act as fiduciaries to our clients, meaning we have a legal obligation to keep your interest above our own. Our allegiance is to the client and to no one else. There's no one over our shoulder saying, hey, if you recommend mutual fund A versus mutual fund B, you're going to earn more. Or if you sell a certain amount of bonds from a certain bond house, you're going to get a trip. You're going to go to a Yankee game and you're going to be in box seats and you're going to meet Derek Jeter. We don't operate under that umbrella. And now I'd like to bring up Jim, who's going to be talking about the lively topic of taxes.
Thank you. So if you look back since 1919, actually, the average historical top marginal federal tax rate was 60%. It was as low as 7% in 1913. And as high as 94% in 1944 through 45. So that's the purple line. Orange is dividends. And you can see they overlap each other through most of history. A couple of months ago, the president signed the American Tax Relief Act of 2012. And this was some of the biggest tax changes in years. So we wanted you to know what's going on this. So keep in mind, 60% is the historical top tax rate. Now it's 43.4%. So everything here in orange is the current tax rule. The first column is wage income. For couples making more than $450,000 or individuals making more than $400,000, your new top tax rate is 43.4%. That includes the new healthcare tax. Next column is capital gains. Capital gains moved up. Again, for those high earners, $450,000 if you're a couple, 23.8% is your capital gains. And it's the same as dividends. So earlier you saw orange and purple meeting. It's decoupled. Wage income is different than capital gains and dividends, which is good. They carried that forward. Next column is payroll taxes. They moved up 2% to 12.4%. But really what happened was we got a 2% tax break the last 2 years, in 2011 and 2012. That expired. That's why we're back up to 12.4%. And this last column is estate taxes. A good thing came out of the new act, which is now we know what the threshold is. It's $5 million. So when you die, your heirs don't get taxed on anything they receive up to $5 million. That's totally federal tax free. Any dollar after that is taxed at 40%. A couple of other changes that are important is if you're a couple and your taxable income is more than $250,000, you're going to get hit with a net investment income tax of 3.8%, and you're going to lose some itemized deductions and some personal exemptions. So let's say your income is in between the $250,000 and the $450,000. That's where tax planning is very important, because you're not in the top tax bracket yet, but you are losing some of these exemptions and deductions, and you're getting hit with this 3.8% tax. What we do is we look at each of your tax situations individually. We know who's in the highest tax brackets, and we'll invest accordingly with tax-free munis and other strategies. We look at where to place money as well. If you have money in regular taxable accounts like joint accounts or individual accounts, we'll put less taxed assets in there. So we're always looking about how do we lower this client's taxes and, of course, protect the money and grow the money. So now we know where taxes were and we know what taxes are now. What do you do about it is the following. Earn as much money as you can. Even though taxes have gone up, don't let that hold you back from going into these top tax brackets. The net result to you is you're still taking home more money. So sometimes there's a misconception. If I make too much, I'm going into a different tax bracket, I take home less. We have a graduated tax system. Keep making money. Number two is max out your retirement savings or contribute as much as you can every year. Anytime you could put money away tax deferred, do it. Because first, you're getting a tax break. It's tax deductible, usually. Second, it's a tax deferred growth. So it's a beautiful place to put money away for retirement. In 2013, if you have a 401k, you could put $17,500 into that, another $5,500 as a catch-up. So if you're over 50, you could put away $23,000 in your 401k. IRAs went up. The old rule was $5,000. Now you can put away $5,500. And you could put away another $1,000 if you're over 50. So you can potentially put away $6,500 in your IRA. So do it. Make that a habit. Keep doing it every year, because that's what's going to get your nest egg growing. And the third bullet is something we want to reiterate to clients. We know we bring this up usually at a meeting. Get estate planning documents. Even though those thresholds went up, where your heirs aren't paying federal estate taxes until $5 million, doesn't stop you from needing planning, especially the three basic documents: the will, durable power of attorney, and advanced medical directive. If you have them and they're old, get them looked at again. If you don't have an estate planner that is competent or that you trust, we know some. We can recommend them. Some of them are here today. So definitely, that's definitely a high priority for us. See that estate plan is correct. And we coordinate with your estate planning lawyer to make sure what we're doing matches your overall estate plan. Thank you for listening to me and about the taxes. And now we hold it over to Laura.
First of all, good evening. My objective tonight is to provide you with some context to why we invited this special guest speaker to come talk to you. Okay. And I guess the two components that I really want to bring home are getting you to understand a little bit about what it means to be an efficient market, and also to understand what small cap stocks are about and why they have a role in your portfolio. Now, many people have trouble. They feel that the markets are mysterious. They don't really understand why the markets go up or down. This cartoon actually shows how people are making buy-sell decisions based upon arbitrary information being given out. And you know, clearly, the markets move on information, but our hope is, and generally speaking, most of the information, when analysts do review information, they are looking at the source and the quality of that information. I'd like to talk a little bit about the fact that the information that they use tends to make the price of the stock be the value of the stock. So when you think about, let me just get rid of this for a second, because I just want to back up a minute. When you think about the theory behind pricing stock, it's all about looking at future cash flows. What are we looking at when we look at future cash flows? We're looking at information based upon the company. We're looking at their products, their competition, the economic environment, and we're making forecasts into the future. And based upon the information that we have, we're making assessments on what the value of the stock is today. So in theory, the price of the stock is the value of the stock. That is what it means to be efficient. When we talk about efficient markets, generally speaking, it's thought to be that all the information that's out there that's relevant has been accounted for, and the price of the stock is the value of the stock. Just to bring that a little bit more to bear, I wanted to just talk about a situation where it's not an efficient market. And so I want to introduce you to Greedy Gary. Greedy Gary is the CEO of a corporation, and it's Greedy Gary's responsibility to contact the SEC every quarter and to provide information to the public as it becomes apparent to him what's going on. Well, Greedy Gary gets his quarterly sales report, and he finds out that the product that they've been working for years on and now have launched is doing really good. As a matter of fact, it's flying off the shelves. The customers absolutely love it. And so the actual sales have been coming in much higher than forecast. What does he do? Well, he goes and he contacts his girlfriend, Greedy Gail. And Greedy Gail goes and buys some stock based upon that information. Why not? What happens? The stock price goes up. Greedy Gary then decides that, you know what, I really should make an announcement. He makes a public announcement. He files with the SEC. And Innocent Iris hears about it. She says, oh, gee, you know, maybe that company really is turning around. It's doing great. I'm going to buy some stock. What happened here? Greedy Gary and Greedy Gail made a whole lot of money. Innocent Iris, not so much. Now, this is the example of an inefficient market. This is also an example of insider trading. Insider trading is illegal. However, we're not going to be naive Nancys and believe that it never happens, because it does. So this is, of course, inefficient. We then have the opposite side where Greedy Gary, Greedy Gail, and Innocent Iris all get information at the same time, simultaneously. That is perfect efficiency. That is market efficiency at its finest, where every single person knows exactly what's going on with that stock. The truth is that it's somewhere in the middle. What the empirical evidence has demonstrated is that there are some weak forms of market efficiency, but it really isn't as strong as what some people might think. Now, of course, if you watch CNBC or you read Kiplinger or Money Magazine or listen to Bloomberg, you probably have heard a lot about market efficiency because it's very much in vogue, as well as passive investing. Now, passive investing is the idea of taking investments such as exchange-traded funds, ETFs, or index funds, which really are just baskets of stocks that have not been picked or hand-selected. They're just baskets of stocks that represent a market or an asset class. Use that word interchangeably, market, asset class. And the opposite is active management, where somebody goes out and actually reviews all the stocks and looks for stocks that have not been valued correctly. So they're looking for intrinsic value that is implied in the price of the stock. Since probably the past decade, especially, market efficiency and passive investing have become very much in vogue. And what we have seen is, and this chart actually shows it, in 2006, we see the passive management, which is the yellow bar, people flocking to passive investing and leaving active investing, which is the blue bar. What does Barron believe? Well, of course, you guys have gotten to know us for a while, and you know that we never take a firm stand on anything. We generally believe that there are times where active investing is appropriate, and there are times where passive investing is appropriate, and our answer is it depends. It depends upon the situation. And if you look at your portfolio carefully, you will see both passive funds and you will also see actively managed funds. One of the issues here is the area that, as I mentioned, the empirical evidence has come out and it doesn't fully confirm this theory. You know, the economists came out with this wonderful theory of efficient market hypothesis theory, and everything should conform to it. Well, everything doesn't conform to it, and you know, the analysts, the economists don't really like that too much. They spend a lot of time trying to reconcile between reality and their theory. And so what they've done is they've developed a couple of anomalies, and one of the big anomalies is in the small cap space, where they found that there are inefficiencies in the small cap arena. Why is that? There's really two primary reasons for that. First of all, the information flow that I talked about before isn't as smooth as in the large cap space. The second thing is, if you watch CNBC or if you're looking at these magazines, you'll take notice that they're usually talking about large companies. Very often, it's the big, you know, the Googles and the IBMs and the Exxons. They're not talking about the small companies. And so people tend to focus on the large cap companies. A lot of people will buy an index fund. They'll go out and they'll buy an S&P 500 index fund. Well, guess what that is? That's the top 500 companies in the country, the S&P 500. So people tend to really focus on large cap, which means that small cap tends to be neglected. And there are opportunities there. So Barron does look for active managers in this particular asset class because we think that there's opportunity. Just to talk a little bit more about small cap versus large cap, I wanted to show you a comparison. Unfortunately, this is it's not even very clear for me, and I'm standing up here, so I'm sure it's not that great for you either. But the red bars are the S&P 500, which is large cap, and the blue bars are the small cap market. And what we wanted to show is the past 20 years from 1993, which is at the bottom, up through 2012, which is at the top. And you can see that actually with small cap, there have been times, including 2011, where small cap was actually negatively correlated to large cap. In fact, small cap hasn't been doing that well in the past couple of years, and so people have been wondering, why are you in small cap? But in addition to that, you'll also notice that when the asset classes are correlated, they're not perfectly correlated. They still have a low correlation, and small cap does operate as a market diversifier against the large cap stocks. Further, to just play this whole thing out, I took the 20 years return and I said, what if we took $100,000 and we invested it in large cap, the S&P 500, and over the 20 years, and we wound up with $400,000 at the end of the 20 years. I then plotted on top of that, what if we took $100,000 and we invested in small cap, and clearly 25% premium over large cap, so small cap, maybe we should have been all in small cap. But you know that Barron would never do that because we don't believe in putting all our eggs in one basket, and we're not going to speculate on one asset class such as that. So our worst case scenario, if the only two asset classes in the world were small cap and large cap, we'd at least do a 50-50 split, right? So if we did a 50-50 split, if we just do the math and we take the 500,000 plus the 400,000, do an average, we would come up to $453,000. So we would expect that we would have $453,000 at the end of the 20 years. Well, as you know, we've talked a lot about asset allocation in the past. We've talked about volatility, about the idea of putting two asset classes together to smooth volatility. And this is just one more example of that. Actually, the average is $10,000 more By combining these two asset classes, we are not in the middle. We don't get the average dollar amount of the two asset class. We actually get more, and that's because, again, smoothing out volatility and not incurring that additional volatility drag. And this is what we see every time. And so, again, the role of small cap in your portfolio, we continue to think is very important. We also believe that active management for the small cap space is the right place to be. And Tony's going to introduce our guest speaker who represents the small cap industry and bring that a little bit more to light in terms of what's going on there.
Thanks, Laura. Well, sitting here next to me, we have Ed Coyne, and he is a principal at Royce & Associates. He's worked in the financial industry for 19 years, and 15 of those years he's spent with Royce. Earlier, you heard Laura talk about both active and passive investing. And at Barron, we think using both are important. And what we really think you'll hear tonight is really a dynamic discussion about how Royce uses active management in the small cap space. So I guess, at Barron clients know, and prospective clients hopefully know, we look at roughly 12 different asset classes when we're designing investment strategies. And one of those asset classes is small cap stocks. And within that asset class, an approved fund that we have is Royce Special Equity Fund. It's a small cap fund. But before we get into the details about that fund, I was hoping maybe, Ed, you could give us a background of Royce in general and tell us about your company.
First, thank you for coming out tonight. This is a real treat to do this. Personally, I only manage one account, which is my mother's account. And I've had some success with that because I've spent a lot of time focusing on the risk side, much like what Barron does. And one of the things that's unique about our firm is, although small cap is one of the more dynamic asset classes out there that delivers very attractive returns, it's very volatile. We have focused on this asset class for over 4 decades. So 40+ years now, we've been focused on nothing but small cap. As the small cap asset class has continued to mature, we've continued to stay focused on it and not diversify into large cap and fixed income and so forth. A lot of the things that were mentioned already tonight about the inefficiencies of the asset class are areas that we find opportunity in. So we've continued to build out this space. I think it's what makes us unique as a firm, is that we've continued to focus on a single asset class. We're about $35 billion of total assets that we manage. We're approximately about 120 people. And probably the most exciting thing about what we do, or the most interesting thing for you all, is what Barron also does, which is we eat our own cooking. So we tend to be heavily invested in our portfolios. As I mentioned, we're about 120 people. We've got north of 150 million of our own money in the funds, whether it's our taxable accounts or our 401k accounts. So we're very committed to what we do. We're very focused on what we do. And the asset class itself has continued to mature. And with that, I'll hand it back over to you, and we can maybe go into the small cap space a bit.
Sure. Well, if you've ever been into a meeting with Victor, of course, we know, we love the food references. We eat our own cooking at Barron too, and the way we design strategies for clients, we use those same exact approaches to invest our own money. So there are a lot of similarities there between Royce and how we operate, which is, we think very important. I was hoping maybe, I don't know if you guys know this, but Royce is a wholly owned subsidiary of Legg Mason, and maybe you could touch a little bit about how that relationship works and how Royce services the registered investment advisory community and firms such as Barron.
Sure, thanks. Yeah, the Legg Mason relationship is a unique one. Some here may know the name Legg Mason. They're based out of Baltimore. Prior to Legg buying us, we were a single-owned company by Chuck Royce, the CEO of the firm and the president of Royce & Associates, who founded the firm back in '73. He had turned 60, and from an estate planning standpoint, we wanted to make sure the firm was going to continue to grow above and beyond Mr. Royce. Now, he's still very much involved day in, day out, but time does click on, and we want to make sure this firm continues to be there for our investors and for all the employees of the firm. So we specifically sought out a firm like Legg Mason to partner with. And they acquired us back in October of 2001. So it's nothing new for us. We've been at this for over 12 years now. It's been a very successful relationship for us. It's been a very successful relationship for Legg Mason. And it's given us a nice platform to build our firm on. Because the one thing we were finding is that as we were getting larger, it was hard to attract additional talent to our shop because it was a single-owned, privately held company. And by going with a larger platform like a Legg Mason as a parent company, it allowed us to bring additional talent in. So we've got a very large seasoned staff of over 45 investment professionals now focused on this asset class, and Legg's been a wonderful partner for that. In addition to that, we have always been an asset manager. We don't think of ourselves as a marketer. We don't go out and sell product. That's not really our style. What our style is really just to find the best investments out there we can manage and let folks like Barron do their due diligence and come to us. I refer to it as reactive marketing. Barron calls us, of course we'll call them back. They express interest in us, of course we'll support that interest. What Legg has helped us with is to give us meaningful support in the field. I'm basically for lack of a better word, the marketer of Royce. So I kind of go across the country, but I can only be in so many places at one time. So in the back there is Ned Bourne, who covers this area. And we've got people kind of all over the country through Legg Mason has helped us with that. So it's been a wonderful relationship, both from an asset management standpoint, but also from a client service standpoint.
Well, I guess now we'll start to get into the good stuff. You know, whenever a client, or often when clients call up and we sit down for meetings, one of the topics on their mind is, how am I doing? How are my returns? When prospective clients meet with us, they want to know what types of returns can we expect from Barron Strategies. But of course, it's not just an answer that we give that's about returns. We really have to incorporate risk into the discussion. That's a very important objective along with return, is to incorporate the risk profile that you're taking to earn that return. So at Barron, we think that the discussion is never just return-based only. It is the risk that you take to earn the returns. Ed, can you touch on how Royce views those perspectives and what your viewpoint is on risk and return?
Yeah, risk is the word for us day in, day out. The reality is, in a rising market, you're going to make money. If you look at what happened in the late 90s when indexes were going up, everyone was making money. I would go and get in a cab to head to the airport, and the taxi driver, not to belittle taxi drivers, but the taxi driver would ask me what I did for a living, and I would tell him, and he would proceed to give me 5 stocks we should be buying. And it was really fascinating. When the markets are going up, you're going to participate. That's the facts. The problem is when the markets are stagnant or go down, is unrelentless how bad that can be for people. And if by you just focusing on the return side of it and not focusing on the risk side of it, it's very hard to make money over full market cycles. I always equate it to a dog chasing its tail with volatility. There's a lot of action going on, but very little results. And the downside's very important part of what we do day in, day out. We start every day focused on balance sheet first. And I think of it the way you should think about your personal finances. You know, when you get out of college, you maybe have some student loan debts, you get married, you buy your first house, you have a child. You don't have a lot of cash. You probably have a fair amount of debt. That's not the kind of business we want to own. Now, when I look out here in the audience, a lot of you, if I see you as businesses, I'd like to be part of your business right now because you've probably raised your kids. You've probably sent them through college. Maybe your mortgage is close to being paid off. Probably got a little cash in your pocket now. You don't have a lot of debt. You probably have a fair amount of cash. Maybe you have a second home. You've got some real assets. That's a great business. And that gives you a greater rate of survivability. So we're always thinking about that first and foremost. If a left field occurrence happens, is this a healthy company or an unhealthy company? And that health is going to come on the shoulders of balance sheet quality. So we look for low leveraged companies, not a lot of debt. We look for companies that have tons of cash on their balance sheet, particularly in small cap. That's important because they can't go knock on the door of the local banker to borrow money to buy a new factory or buy new trucks and so forth. In many cases, they have to self-fund that themselves. So those companies that don't have a lot of debt, that have that cash, they can survive that left field occurrence when it happens. And rest assured, it does happen. We saw what happened in 2007, 2008, and early part of 2009 with large cap companies. So you can imagine how volatile the small cap space is. And so we think of debt and balance sheets as really a survivability factor. So we're always focused on that first. And just by way of example, the fund you all use, Royce Special Equity, which is in most likely most or hopefully all of your portfolios, is the upmarket and downmarket capture ratios, meaning how often do we participate in the ups versus the downs. And we get about 80 to 85% of the ups right. So we're participating nicely in the ups. More importantly, we only get about 45 to 55% of the downs. So we're giving up a lot less on the downs, and that's based off the strength of those balance sheets of the companies we buy. So if you look at it on over a 3 or 5 or 7 year market cycle, we've been able to consistently outperform the market, and more importantly, do it with less volatility. And that's important because the lower the volatility, the more likely you'll stay in the fund, and the more likely you'll get those nice return patterns that were shown on the chart earlier. If it's very volatile, it's not very fun to hang on to that. So we're trying to always limit that volatility through the strength of balance sheets.
Yeah, I think those are great points. Some of the terms that I hear Ed talking about, it's great to hear. Full market cycle, upside capture, downside capture, volatility. Those things are all important when we're considering how to build strategies for clients. And if you're familiar with our moniker, High Stability Wealth Management, that's what leads us there. And really, it's a consistent approach where we're validating our strategies, we're doing solid asset selection, and we're rebalancing. So I think it's that consistent approach that makes us both unique and strong together. I was hoping maybe too, Ed, you could touch on how you guys deal with taking short-term market movements and generating a long-term market perspective, keeping a long-term perspective as you're dealing with short-term market movements.
For us, the short-term volatility is really our friend. It's really the fuel for our long-term results. Without volatility, you don't really get an entry point into the market. So we sort of think of ourselves as going shopping on December 26th and 27th, not on the 23rd and 24th. We're always looking at companies that have some sort of left field occurrence happen that's not detrimental to the long-term growth of the company, but it's a disruption to the short-term growth of the company. So it could be a CEO is leaving, or it could be the industry as a whole has gotten a black mark on it, and good companies, bad companies are being washed out because of that. It could be a broader economic thing that has nothing to do with the business, but people moving away from equities in general, like we saw in 2008. We're looking for some sort of disruption out there as far as how we can go in and buy these companies. So the short-term market moves for us are really opportunities for us. We see those as wonderful entry points. I was talking with actually Chuck Royce yesterday about this, and one of the things he said I thought was great, which is it's okay to lose money in the long term, the short term. If you lose that money in the short term, it really allows you to make that money over the full market cycle. And if you take advantage of that and you stay calm over those short market cycles and those short market disruptions, and you continue to add money into those types of investments over those full cycles, you should do better than the market because you're gaining more market share. And as I always tell the portfolio managers, in very volatile markets, I wasn't there today, we had a negative day today, but I would have probably been up there talking about this today, as I call these days share collection days. Forget your dollar value, focus on your share amount. On negative days, you're trying to get more shares. End of story. Our turnover is about anywhere from 10 to 25%, which means how rapidly we're buying and selling stocks. We're typically holding companies for 5 to 7 years. The typical small cap manager, even the indexes for that matter, are turning over portfolios over 100% a year. We're buying businesses. We think of ourselves as going out and buying an actual business, not buying the stock. Because the price of a stock in many cases has very little to do with what the value of that actual underlying business is. So we opportunistically take advantage of those gyrations in the price every day. We're slowly building these positions over 3 months, 6 months, some cases 2 or 3 years. And we're holding them over full market cycles. We have some stocks we've owned for 10 or 15 years. So it's a different mindset, and we welcome the volatility in the short term because it really allows us to do what I said earlier, go out there and collect shares. It's a share collection day. And the more you can train yourself to think that way, the better off you'll be. And not as an advertisement for Barron, but I will tell you, it's very helpful to use someone as a sounding board like Barron because it's an emotional process. It's not fun to lose money. I can tell you that. You've lost money in the past. I've lost money in the past. It will happen again in the future. But if you have someone like Barron to think about, okay, what can we be doing now? Is there opportunity out there? That's a great tool to have, and I encourage you to take advantage of that. It's how we run money, it's how we manage money, and the more individual investors can do that, I think the better off you'll be over, again, over a full market cycle.
Thanks. Hopefully you can see here, there are truly a lot of consistencies, and you can see why, you know, Royce Special Equity Fund showed up on our radar. It's because of the consistencies between a long-term approach, controlling risk, protecting the downside, and generating returns over, again, full market cycles. And these are very macro-level topics. Hopefully now maybe we can get into maybe some more micro-level topics. So hopefully maybe you could define exactly what is, you know, a small cap stock, and why should we focus on them?
So the small cap market, to the extent you can or can't see this up here, it's really three separate buckets, or as I call them, they're sort of avenues of opportunities that we find from time to time. The micro cap bucket would be your locals, regional type of businesses in many cases. They do one thing. They make a gasket. They make rubber hosing. There's a company, for example, that we own called Semprit, and they do conveyor belts, rubber surgical gloves, and they have a large market share in rubber handrails for escalators. This is not exciting business, but very profitable business. But it's more of a micro-cap type of company. They pay a dividend. They've been around for a long time. But they do basically one thing, and they're very small, very regionalized. We define that from a market cap standpoint, from an asset or equity standpoint of $750 million and below. So these are the smallest of the small. They don't really talk about them on CNBC and all the different news shows out there because there's not a lot of coverage. In many cases, there's more internal ownership than external ownership. So there's not a lot of shares to be bought every day. So you've got to be disciplined about slowly over time buying that space. Ultimately, that's where the small cap returns come from the micro cap space. You have to be investing in micro cap to get a small cap return premium over time. Special Equity has a nice percent of its portfolio in micro cap stocks, for example. But it's more volatile. So you have to negate some of that volatility with the larger end of small cap, which would be the small cap space. In many cases, these are companies that have been around for a long period of time. They've gone through multiple generations of ownership. There's a great company called Schnitzer Steel that we own that's been around for over 100 years, a U.S. company. They're a scrap metal company. They basically collect scrap. They clean it up, they package it, and in many cases they send it overseas, particularly to India and Asia right now, and they use that for a fuel source for electric arc furnaces, which are used to make plate and rolled steel for buildings and shipbuilding and automotive and so forth. But that's more the small cap space. So these are more developed companies, but still small. You know, I'd be surprised if anyone here has heard of Schnitzer Steel before. But it's just, unless you're in that business, maybe you've heard of it then. But it's a smaller business still. People don't talk about it, but it's got a longer track record. It's been around longer. It's more established. Again, it's probably paying a dividend. Believe it or not, there's over 1,400 companies in our selection universe that pay a dividend, over 700 to have yields of 2% or greater, and that's going to be the small cap space. The last space, which I call sort of an appreciation space, would be the mid cap universe. We're not typically buying companies in this space, but we own companies in this space. And in many cases, these are companies that we have bought over the last decade that we've had success in. We still like them, still want to own them. They're still growing, and they've become more of a mid-cap. It's sort of the last stage before you become a large cap stock. So we're constantly investing in this universe. It is inefficient. It's large. It's about 85% of all publicly traded companies in the United States fall in this category. The problem is a lot of them aren't very attractive from a balance sheet standpoint. So having that risk control, that risk parameter is a very important selection mechanism of looking at these types of companies. But it is the most attractive asset class in our view over long periods of time. If you look at it on a quarter-to-quarter basis or even a calendar year basis, you may not like what you see. It can be very volatile. But again, over those 3 to 5 year and rolling market cycle basis, it does deliver very nice returns if you have the patience to stay with it. And that's really the key, is staying with it. So that's the asset class.
Well, I mentioned earlier at Barron, we focus on 12 different asset classes. And when we look at each asset class, we come up with some expectations for both returns and for risk. And I was wondering, you know, in the small cap space, is exposure over the long term still attractive? Is it still an attractive place to be?
Of course, I'm going to say yes. But it is, actually. What's interesting is the last couple years, we've had our own challenges with performance on a relative basis, meaning if the market's up 10, we may be up 8. We're making money, but not as much as the market. And part of that's because what we value as important hasn't been truly appreciated or recognized in the broader market. We focus on low leverage, as I mentioned earlier, companies. We focus on very cash-rich companies. We focus on companies that have higher returns on invested capital. There hasn't been a great reward for being a cash-rich, low-leverage company. You've gotten some attention in the large cap space, but the small cap space really hasn't gotten a lot of attention. What's gotten attention is the companies that have had the greatest rate of change. And the cost of capital right now is so low that you can go and refinance or restructure your debt, both your short-term borrowings and your long-term borrowings, your financial leverage and your operating leverage, restructure that, and that will have an immediate impact on your bottom line. Now, that's a cost savings. That's not a value creation. That's not a growth of the business. The business isn't necessarily doing better. It's just spending less. And so the market's rewarding that right now. Well, we want to look at companies that are growing and creating value over full cycles. So our part of the space that we focus on has been largely ignored. So the higher return on invested capital companies are still trading at, in our estimate, anywhere from a 15 to 20% discount, where the lower return on invested capital companies that have had the greatest rate of change are trading as much as a 50% premium. And if you see in the paper talking about the markets hitting new highs and so forth, a lot of those new highs are on the backs of those lower return on invested capital companies. We think that part of the game is behind us or are coming close behind us. We think that quality trades are starting to show up more. We think that dividends, as we've talked about a bit tonight, are starting to matter more. Good stewards of capital are starting to be more important today than they have been in the last couple years. And so we're encouraged by that. And we think for some of the reasons why we've underperformed on a relative basis, still making money but less than the market has made, are reasons why we think we can outperform going forward, because our style is starting to move back into favor. The last thing I would say to that is large caps have been largely void of making acquisitions the last couple years. Prior to 2007, you almost couldn't open the paper or turn on the TV without hearing who was buying who. That's completely been the opposite the last couple years. We've seen a lot of companies more recently looking to make acquisitions, looking to be acquired, looking to grow their business, large caps looking to manufacture growth. You know, Coca-Cola is not going to go out and buy Pepsi. Coke's going to buy the local bottlers, going to go buy the small juice companies, water companies, snack food companies, and so forth out there. And those are the types of companies we own. So we're encouraged not just by the fact that our style has been largely out of favor. We're also encouraged by the fact that large caps are sitting on records amount of cash. They have the lowest levels of debt that they've had in decades. And they're looking to grow their businesses, and they're looking at our space to do that. So we're actually quite encouraged by and enthusiastic about our asset class.
You know, you can tell that maybe some of the underlying tones for somebody who's really into statistics, some of those comments lead to a topic that's important to us at Barron, which is mean reversion. That's both important for us in our asset allocation strategy. Also, it's important when we're considering rebalancing. I know it's important to you guys. Maybe you can expand on how you guys think about mean reversion and what it means to you at Royce.
That's one of the more powerful tools out there, and not just with us, but really in equities or investing in general. And you could apply mean reversion to almost anything, whether it's sports, you know, personal habits in life, investments, you name it. Mean reversion is a very powerful force. And if you look at this chart, this is one of our favorite charts. In fact, it shows you how nerdy we are. But one year for Christmas, we had this matted in frame for Chuck and hung it in his office. And it's one of his favorite pictures in his office. He has grandkids in his office. He has pictures of his wife in his office. But this is one of his favorite pictures in his office. So that may say some bad things about us, some good things about us, I'm not sure. But this is why we do what we do. It's a very important chart because it goes back to the 1800s, and it shows that you do have ups and you do have downs in the market. And over full market cycles, the market does revert back to a mean, does revert back to averages. And the key is, and why active management is so important, is taking advantage of these inefficiencies. And so when things get a little too expensive, people start to back away from that, back off of it a little bit. Maybe they were going to go buy a vacation home or buy a new car, and car prices or real estate starts getting more and more expensive. Less people start putting bids in for those things, and the stocks or the market starts to revert back to a mean. 2009, real estate. I mean, every day in the newspaper you were seeing what states had the lowest real estate values. They got to a point to where people said, you know what, maybe I will go look at a new house, or maybe I will buy a new car now, or maybe we'll finally buy a vacation home because they've got so inexpensive. And that's what we saw in 2009. And at the very end of that chart, you see the huge kind of hockey stick angle shot straight back up. Again, reverting back to that mean. So we use that as a very powerful mechanism. We think of it really from an entry and exit point strategy. So we look at what things are trading at relative to the historic averages, relative to the long-term averages, and we try to take advantage of that both on the buy side and on the sell side. So we don't ignore it. It's a very important part of the overall process. And again, it's one way over full market cycles you can take advantage of the inefficiencies, is to think about things from a mean reversion standpoint.
As I'm looking at the question I want to ask, I'm going to kind of incorporate two here. Typically at Barron, we think of ourselves as strategic. It means that we create a long-term strategy for clients, and we look at full market cycles. You've heard that term a lot tonight when we're considering rebalancing, considering investment choices that we make. Within that, we do use large cap. You've heard us talk about large cap this evening, and everybody recognizes large cap names like Coke, Google, Microsoft, Apple, Caterpillar, Pfizer. Those are all names that are familiar to all of us out here. So, but maybe you could talk a little bit about kind of the tactical side. I know you guys are more strategic in nature, and we've talked about this in the past, but maybe talk about the tactical side of picking some individual names and give us some perspective or some outlook as to, you know, what some of these smaller businesses do and why they're exciting.
Exciting may not be the word for us for what some of the companies we look at, and you'll get that in a moment when I give you my example. But we do think tactically from a price standpoint, from an entry standpoint. We are strategic as far as looking out over the horizon and thinking about life on a stock by stock basis or company by company basis. We don't say we need to be overweight or underweight sectors and so forth, and tactically dial up and dial down our exposure. We are thinking about this on a business to business basis. But we do look at companies on from a strategic standpoint and from a tactical standpoint, from a pricing standpoint, and also from a compare and contrast standpoint. The example I'm going to give is one that I think is kind of fun to give just because the two businesses are very different. Bulgari is a very high-end watch store. It's about 2 blocks from our office. I can actually see it from my window. And it's similar to a Rolex. These watches go for $45,000 to $60,000 to $100,000. You walk into the store and you feel like you're being belittled immediately before you get through the door. It's one of these kind of places that like, gee, I really want to be part of this. It's very fancy. It's very expensive. It's I don't know if anyone here has a Bulgari watch on, but if you do, I want to talk to you afterwards. But it's one of these great companies on the surface. The problem is that their return on equity, return on assets, return on invested capital are in the single digits in most years. Maybe in a good year they get to 10%. So they spend all this money and time and energy getting their word out there and having the high-end rent and the high-end stores and so forth. But the business itself isn't really that great of a business. The businesses we like is a company called Mayr-Melnhofen. Now, that name in itself, isn't that exciting, and what they do is even less exciting. They buy and manufacture cereal boxes. They do recycled cardboard, and if you take apart one of your cereal boxes, there's a pretty good chance inside you'll see a little typeface that says Mayr-Melnhofen. They make most of the cereal boxes pretty much in the world. great business. Their return on invested capital is in the 25 to 30% range. Nothing fancy about this business, but a great business. They pay a dividend. They've got very little debt, tons of cash, and so forth. And so from a tactical standpoint or from a strategic standpoint, you look at those two businesses and say, from the outside, which one would you want to own? Probably the Bulgar V is a more exciting story to talk about at a cocktail party. But when you look at your wallet and look at your balance sheet, the cardboard manufacturer, Mayr-Melnhofen, is really where you want to be. So that's the way we sort of think about different companies when we're thinking about investing, and strategically where we want to be. And then tactically, we look at those companies and say, okay, what are they currently trading at relative to what their breakup value is? And when we say breakup value, is if we were all going to pull our money together today and go buy the entire business, and then a year later sell it, pay off all the creditors, do we have real money we can put in our pocket over and above what we invested in the company? So that has to be important for us. So we're looking for these companies that are trading at a discount to that breakup value. And that's how we opportunistically sort of think about it from both a strategic standpoint, but also from a tactical standpoint.
So if you remember earlier, Laura had that slide with the blue and the red, and trying to see that from where you were. Hopefully you could. But in 2011, you saw that small caps didn't do as well as large caps. In 2012, they kind of caught up. 2013, I didn't check exactly today, but it looks like they're doing a little bit better than large caps. We always say our crystal ball is broken at Barron. You hear this time and time and again. We look at the long term, and we try and make good investments over the long term, and we rebalance as markets move. So, having said all that, I put you on the spot a little bit. Maybe you can give us some perspective as to where you think the small cap sector is going from here today.
Up. No, all kidding aside, we do think the upper end of small cap, frankly, is going to have a more attractive near-term return pattern, partly from what we mentioned earlier about the M&A activity that's picking up in the large cap side, looking to make acquisitions and so forth. Typically, they start at the top and work their way down. You're typically not buying micro cap companies first. You're buying the higher end small cap companies with the better balance sheets and so forth. Once those kind of start to dry up, then you start looking into the micro cap space to make additional acquisitions. The problem is they have less impact on your bottom line. So you're going to start at the upper end first and work your way down. So the small cap space is pretty intriguing right now, particularly dividend paying stocks in that area and so forth. That's pretty much where the fund you're currently invested in lives, is in that small cap space with special equity. We do think over the next probably 1 to 3 years, small cap is going to be sort of the return engine within our universe. Over the next 5 to 10 years, I think micro cap still continues to be a very powerful part of the return pattern. But I think in the near term, the higher quality small cap space is going to be where we see the bulk of our returns come from.
Well, I think that does it for the questions that we wanted to cover here tonight. I want to reiterate some of the things, Victor and Laura both said in their presentations. Victor was talking about how we have a strict discipline when we go out and choose our investments for clients. And Laura talked about some of the important profiles of being not just in the most favorite item at the most favorite time, but to look elsewhere and find attractive investments in the marketplace. So, when you look at our relationship with Royce and what we have and where our clients have been invested in their fund, the performance has been very good, and we've been very happy with it. When you incorporate risk metrics into it along with the return, we think it's outstanding. So I want to say thank you to Ed and thank you to Ned for coming out tonight and sharing their thoughts. To all of you, certainly feel free to come up to us during Victor eating the fruit tart and ask us any questions you'd like. Hope you enjoyed our presentation, and I'm going to give it back to Victor.
By having something like this, a discussion in a forum like this, we're letting you inside what happens, what we're looking to do on a daily basis, how we dig down into the mutual fund managers, and to make sure that they're doing what we bought them for. And if that sways for any reason, Ed knows that at any point, his feet are to the fire. that our allegiance is to the client and to make sure that we're picking the best returns, the best investments for our client. And we're always going to be in that top percentile. We remain confident in our proactive all-weather strategy, which is that's definitely part of it. We will always continue to review our strategies to ensure that risk profile matches the client while maximizing your overall expected return. But nevertheless, we will always challenge ourselves to continue to deliver a consistent, high-quality experience, always stressing service and performance. At this point, I want to hand it over to Nick for some housekeeping.
Okay, everyone. When you walked in, you should have gotten a survey. And if you can fill that out and hand it to Fran when you exit the theater. If you haven't got a survey, we have several for you. I'd like to reiterate what Tony said. The whole BFG team and Ed and Ned will be outside in the lobby. So feel free to come up to us and ask us any questions. And we appreciate the confidence that you have all demonstrated in us and your understanding and our commitment to the power of responsible guidance. Now at this time, I'd like to hope everyone has a nice rest of the evening, enjoy some of the desserts and coffee, and everyone have a safe trip home. Thank you and good night.